CrowdStrike just reported Q1 numbers and the market's response was, well, not great. Shares are down 11% after hours, but it's not obvious why. On its face, the report looked good. Revenue was up 42% to $693 million. Annual recurring revenue was also up 42%, gross margin increased 1%, and the company generated $227 million in free cash flow. Looking at the bigger picture, that means CrowdStrike has generated $2.4 billion of revenue over the last 12 months, $782 million of free cash flow, but net income was negative at minus $151 million. The enterprise value is just under $31 billion, so the company is now valued at 13 times revenue and 40 times free cash flow. CrowdStrike also released strong guidance for the rest of the year, with revenues forecast to come in at $3 billion. So why is the stock down? Perhaps the main reason is that the company is still not showing positive net income. The company is guiding for $580 million of non-GAAP net income for the rest of the year, but a lot of that gets eaten up by stock-based compensation. More generally, CrowdStrike is an expensive stock. It trades at 57 times adjusted net income and 13 times revenue. When expectations are so high, it's easy for earnings to disappoint investors. And although CrowdStrike continues to grow, its revenue growth rate has dropped every year now since it went public. Considering this year's growth is expected to come in around 36%, the analyst forecast for above 30% growth for the next few years now looks optimistic. So let's consider one hypothetical scenario where CrowdStrike hits $3 billion in revenue this year and then compounds at 25% growth for the 4 years after that. That would put revenues at $7.3 billion, and a 20% net margin puts net income at around $1.5 billion in 5 years' time. Apply a 35 times multiple to that figure, gets us to a market cap of $51 billion, which works out to an investment return of 9% per year, and that's quite an aggressive scenario. So you can see that CrowdStrike is still rather expensive even after the 11% drop in share price. To get a better investment return, CrowdStrike needs to grow faster than 25% per year or increase its net income margin to over 20%. CrowdStrike could do that because it's a quality business, but so much growth is priced in, it doesn't leave any margin of safety. For that reason, I give the stock a neutral rating, but these are my personal opinions and I've got no position in the stock.